Hi everyone, and welcome to our webinar on capital raising essentials for startups. My name is Sarah Aldersley and I'm a practice leader in LegalVision's corporate team. And I'm joined today by my colleague Michaela O'Connor, who's a senior lawyer also in our corporate team. So before we begin, just a couple of quick housekeeping items. So you will receive this recording and slides in your email, so don't worry too much about making lots of notes. If you have any questions as we're going on, then please submit them in the chat box and then we'll answer them at the end. We have had some pre-submitted questions as well, but as I said, if anything comes up, just put your question in the chat box. There'll also be a survey that gets sent around after the webinar. Please fill this in, it's always really good to get any feedback that you have. Also, everyone joining today is eligible to receive a free consultation with us to discuss how we can help you with any of your contracts or any of your broader legal needs. To request that free consultation, just pop your contact details in the survey that will come around at the end. Perfect. So today we will be discussing how to raise capital. So that's the different types of investment that you could consider, and also how to get your business ready for a raise. We'll also then dive into the legal documentation that you would need if you were going through an equity capital raise. At the end, as I said, we'll then be answering some of your questions, so please do pop them in the chat function throughout the webinar if anything does come up for you. So Michaela will kick us off and she'll run you through the start of your funding journey and a few types of capital raising.
Thanks, Sarah. So I guess the first thing to be thinking about is, as you're developing your business, you might initially as a founder be putting funding into the company, so you're self-funding, which we usually do call bootstrapping. But as the business develops, you're going to launch, you're building your offering and your team members, so employees, contractors, you might need additional capital in the company. And there's a couple of different ways to raise capital. So the first couple that I'll go through are loans and equity, which are probably your main forms, and then Sarah will run through a couple of the other forms as well. So with loans being the first form, this can come in different types of loans. So you've got traditional bank loans where you will go to the bank, ask for a business loan. They may require a certain interest rate to be on that loan, as well as some form of security to be provided. Another type of loan could be just from friends and family, happy to provide you with money in exchange for getting that back over a period of time. And then another type of loan could be what we call venture debt. So this is usually a loan that's provided by venture capitalists, and generally that's between equity fundraising rounds. Now, those different types of loans will come with a different level of complexity, demands and hoops that you'll have to jump through. So a few of the downsides that you should be thinking about if you're looking to raise capital through a loan is there could be interest payments and charges associated. So particularly with banks, they may have certain charges, so daily fees. They could also have certain default charges that they will apply if you are in default. So it's something to factor in. You may also need to grant security over the company or the assets, which is a downside. And as an addition to that, if you are a director, then you might also be required to give a personal guarantee. So with that personal guarantee, if you do own your own property, then that could put your own house at risk as well. If you can't pay the loan off at the end of the term, so if you are in default or you can't pay it off, then the lender could possibly apply to liquidate the company as well to get paid back what it can. Now, whilst there are the downsides, there are also upsides to receiving a loan, and the main one of those is you're not actually giving any ownership away in the company. So once the debt's paid off, you usually own your company outright unless there's other shareholders, and the lender doesn't benefit from any growth in the business going forward. So as an added bonus to that, you're keeping control of the business because you're not giving away any form of equity stake. And it might be that there are undertakings you have to agree to. So one of those might be, for instance, that you're not going to sell off a key asset in the company whilst there's that loan in place. But provided that you're complying with the loan agreement, you're usually fine to run the business day to day as you wish. Now that's loans, so that's one form of raising capital. Another form which we will predominantly focus on today is equity. So this is usually where you're getting investment in the company, and that's typically in return for shares. So that investment could be from friends, family, what we call angel investors, or even venture capitalists, which are what we call VCs. Downsides of this is it's the complete flip of loans. So you are giving away a part of your business. So you are giving away a form of control in the business, a percentage of equity in the business. And it's important to think carefully, given that, around the company's valuation and how much you're actually willing to offer to investors. Now, as a result of giving away the control in the company, that might be at both board and shareholder level. So one thing to think about is generally with investors, you're giving away shares. So at shareholder level, you're giving away a certain portion of control, but some investors might also require a board seat. So that's where they might want to be a director as well. Now, most of your decisions day to day are made at the board level, and each director will have one vote per board seat. So one director will have one vote, and it's not actually tied to how many shares they own in the company, meaning they might have a certain level of control at that board level as opposed to what they'd have at shareholder level. So if they're a 10% shareholder, their voting rights at shareholder level are obviously not as much as if they're 1 out of 3 directors, because it's 1 vote per director. So that's something to think about when you're negotiating the commercial terms. You may want to also make sure that the founder team has a certain level of control in the company for a period of time. So one of the founder rights might be that in order for a quorum for a shareholder meeting to proceed, a founder has to be present. Investors might also require certain veto rights as well over certain decisions in the company. So they're all things that you'd be negotiating as part of that equity raise. Another downside is it is a long-term commitment. So generally, shareholders will continue to hold their shares until there's a liquidity event, and that usually isn't until there's a sale in the company. So they stay around for quite a long time. Now, whilst there are downsides, there are upsides to it. It is less risky than a loan, generally because if the company isn't doing well, there's no requirement to pay the investor back their money. There are also tax reliefs available for investors in startups, so it's SEIS and EIS, which makes it more attractive for them to be putting money into the company as well. Now, investors, depending on the type of investor, they can come with their own networks, their own contacts, which can also help you grow your business as well. So I'll just hand back over to Sarah, who will go through some of the other forms of raising capital that we see.
Thanks, Michaela. So we went through loans and we went through equity. So there are actually some instruments which are kind of hybrid of both of these, called convertible instruments. So one of them is a convertible note, which you might have heard of. So this is the one where it really is a hybrid debt and equity instrument. So how this works is you would get the investment in now, but you wouldn't have an obligation to give the shares to the investor until later on, typically on the occurrence of a trigger event, which could be a capital raise or an exit event. When those trigger events happen, the price at which you will issue shares to that investor is actually a discount to the price that you're selling shares to everyone else. Often this can be up to a 30% discount, but this gets negotiated with the investor. The reason why it's hybrid debt and equity, that's the equity part, so they can get shares on a trigger event. But if you get to a particular long stop date and there hasn't been a trigger event, then the company still has to pay back the investment as if it was a loan. You can also have it so that on certain trigger events, the company or perhaps the investor has the right to elect to be repaid the loan rather than actually getting shares. So that's where you can really see that it is kind of a hybrid between both of those. And interest is normally payable as well in the same way that it would be on a loan. There's another one called an advanced subscription agreement, which you might also have heard of as a SAFE. So it's similar to a convertible note in that you get investment up front and then you don't have an obligation to give shares to the investor until there's a trigger event, but it is a purely equity instrument. So there's no point at which you're going to have to repay back the investment funds. It will just stay outstanding until you can issue shares. And same premise as convertible note, if you do issue shares to the investor, they're normally at a discount to reward them really for having invested in your company earlier on than other people. So the advantages to this, they're very quick to raise capital. You don't actually need to agree your company valuation just yet. So the whole reason why that is because you're just giving shares at a discounted price when you're doing, say, a capital raise in the future. So right now you're not agreeing actually what the value of the shares are. You're just taking in the cash and saying, say it was 50 grand, I'll give you 50 grand's worth of shares as and when I do a capital raise, and I'll give you a 20% discount to the price everyone else is paying, for example. This also means you don't have to negotiate sort of longer form documents just now either. So the articles and shareholders agreement that we'll talk about later, those can sort of be parked until you do your full capital raise. It's just the convertible note or the advance subscription agreement that needs to be entered into now. Particularly for a convertible note, the upside of that is it might be possible to negotiate terms where you have the right to repay the investment in cash rather than giving away equity, which obviously if you can do that and you want to, it is a good thing because then you're not giving up as much control and the investors then walking away with their cash but not getting any further growth in the business. With an advanced subscription or a safe note, the kind of the opposite is true, but that can be an advantage if you're particularly worried about having to actually pay the money back. There's no risk with an advanced subscription because the only thing you're going to ever have to do is give them shares. You're never going to have to repay that money back. There can be some downsides though, because you're not setting your valuation up front and you're just agreeing a discounted price for the future. There could potentially be a scenario where you end up giving away more equity than you wanted to. If, for example, your valuation doesn't actually go up that much between now and when you do your capital raise, and then you're giving someone quite a big discount, they could actually end up getting shares for a pretty cheap price, maybe cheaper than what you would have given them for right now. But ideally you've got growth going in the company, so that's not going to be as much of a concern. There are then some other funds that you can get capital from, other sources. So one could be crowdfunding. So you've probably heard of this and seen this. It's getting reasonably popular now. It can range anything from giving away a free product or giving away your services for a discount in return for someone's funding, but it can go all the way up to effectively an equity raise where you've got lots of different members of the public giving you cash and then you're giving them shares in return. There is kind of a neat way of doing this, and if you use sort of a crowdfunding platform, it will always be the case that they will have sort of a nominee entity that will hold the shares on behalf of those investors. So you're not having kind of 100 shareholders on your cap table with every individual person being listed there. So it's quite a neat way to do that. You could also apply for a grant. So sometimes you have to match funds, but there are kind of government and R&D grants available where you don't have to do that. It depends on your industry and kind of where you're located as to what grants actually are available. And there are also R&D loans and R&D tax incentives that lots of startups take advantage of as well. Great, so that's all the kind of types of investments, or at least the key types that we see. So once you've decided what you're going for, you need to be thinking about what's the next step in order to make this happen. We're focusing largely on equity fundraising here, but the same would apply if you were getting bank debt as well, or perhaps a convertible note. So it's a really good idea to make sure that you get your house in order before approaching investors or going too far down the line. The more organised you are, obviously, the more investors will have confidence in you as a founder and in your business. So if you can show that you've complied with kind of obligations and you've got proper documentation in place, then you're going to be considered less of a risk. It's more likely that investor is going to want to invest. So most professional investors will carry out some level of due diligence, which we often call DD, but it does vary. If you've got friends and family investing, it's likely they're not really going to want to look at too much. But it's always good to have this in the back of your mind and make sure that you're sort of prepared if any questions do come your way. If you've actually got to a point where there's lots and lots of documents that you've got for your business, you're going to have to be giving those over to the investors. It's a good idea to start thinking about, even quite far in advance, to have some sort of data room or maybe even just a shared Google Drive or a Dropbox where everything important is kept. So it's nice and easy to be shared and it's organised. Just a point that it often takes longer than you think to go through this process, especially depending on where your starting point is, kind of how much you have to get ready before the investment round goes through. So, you're going to have to do your homework, work out what investment type you want, who you're going to pitch to, and if that's successful, going through the DD process and then negotiating your legal documents. So, to be honest, it can be anywhere from 3 up to say 12 months from start to finish. So that's really from when you're starting to raise until the money coming in. So it really depends how complex it is, how long it takes for you to find an investor. So I thought it would also be helpful to touch on a few kind of non-legal things that aren't necessarily areas that we would help with as more accountants, but it's always good to bear in mind because it will form part of what DD the investors are looking at. So one is to do with your finances. So make sure you're tracking your finances and your metrics. Make sure you're consistently reporting each month and tracking your cash flow, etc. So that when the investor has questions for you about how you're spending money, you can answer those quite easily. Also, your business plan. So investors will always want to see a business plan, typically setting out kind of the next 3 years or so where you see your business growing. Also, this should explain what you need the capital injection for. So what are you actually planning to use this money for? Also, how much capital you are raising. So if you think about how much capital you need versus what you're spending it for, typically you want to be giving yourself around 18 months runway. So you don't want to be raising an amount where actually it's going to run out in say 3 months and then you're going to be back at square one. You want to make sure you're setting yourself up in a way where you can last for around 18 months, or at least until you've launched your product, for example, you've gone out to market, or you've achieved your next big step that you're raising that money for. Also, if you are obviously giving away equity, as Michaela said, you are going to be diluting yourself. So you need to be thinking about in terms of, okay, I'm doing this fundraising round, I'm going to be giving away equity. Might I do some more fundraising rounds in future where I'll have to give away more? So really, you don't want to be giving away more than say 10 up to 25% of the company each round, or perhaps in total, depending on sort of how strong your business is. So it's often better to set a sort of more modest round size that you then fill and can increase if needed, rather than setting yourself a massive target that you then don't reach. Great, so that's for the non-legal bit. So moving back to the more legal side of things, I'll hand back to Michaela.
Thanks, Sarah. So off the back of what Sarah was saying around working out the raise round sizes and things like that, it will become important to have what we call a cap table. So it's just basically a table which sets out your share classes, the amount of shares you have in the company, and then can also work out how much you're going to look at allocating. Now, usually you will see this in, say, an Excel spreadsheet form, just because it's easy to amend and update as you need. Now, what you'll usually have included in there, so you'll have all of your issued classes or shares and all classes, so that you can see how much each shareholder holds. You'll also have generally your employee share option pool allocated on there as well as any convertible notes and advanced subscription agreements to allocate the shares or securities that would be provided under those. Now, what's important to be thinking about here is if there's any shares or options that have been promised by the company but haven't actually been issued yet. So generally, this might be to say employees or people who provided services to the company, so contractors, and this will usually have to be sorted pre-investment, because what the investor will want to see is that everyone on the cap table is allocated there. So even if there hasn't been anything signed, but you've promised, I'll give you 2% in exchange for your services, they'll want to see that allocated on the cap table, because for them, they'll want to see what they're getting once all of those options and shares have actually been issued, because they won't want to be diluted more than what they've actually agreed to. So as a result of that, if you are looking at doing what we call an employee share option plan, so an ESOP, you will on your cap table usually have an allocation for how much of an ESOP you want. So that might be 10 to 20% of the capital of the company. And even if you haven't offered those options to employees yet, usually on your cap table, it will account for the full option pool. Otherwise, the investor will be diluted once those options are actually issued. So they want to make sure that they know exactly what they're receiving once all of those shares have been allocated. So the next thing off the back of that to be thinking about, and that you will be negotiating with the investor, is what type of shares they're actually going to be receiving. Now, there's a few different ways to do this, and it might depend on the investor. It might depend on what you're willing to actually offer. One class of shares would be your ordinary shares. That's just your base share rights. Generally, founders will hold ordinary shares, but then you might also hear the terms of preference or non-voting shares. Now, in a share class, you'll usually have 3 different types of share rights. So the first one will be your voting rights, and that's whether a shareholder has voting or non-voting rights. Generally, investors will want to receive voting rights so that they do have a level of say in the company. Non-voting shares may be issued to, say, family or friends who don't really want to have any sort of voting power in the company, are happy to just take a back seat. The other thing to be thinking about is, the other types of rights in the share classes would be dividends and capital rights. So with dividends, if the company is declaring a dividend, then that's where investors might want what we call preference share class. And that just basically means that if a dividend's declared, they have preference over ordinary shareholders for those dividends. Now, that is also the same with capital rights. So in the instance that the company is sold or there is a liquidation, a preferential shareholder will actually be paid out the capital before ordinary shareholders. So that will all be determined in your articles or your shareholders agreement around the share classes, but they're all things to be thinking about when you're negotiating with the investor, because it's quite important for future control and rights in the company around what each shareholder holds and their share class and rights. The next thing to be thinking about, and that you'll need to make sure is in order, is your company structure and records. So the first thing to be asking is probably if you have a single company structure or if there's a group structure. So a group structure being where you have a holding company, subsidiary operating companies, maybe one or more. And if you do have a group structure, it's important to make sure that the assets that the companies hold are actually sitting in the right company. So for instance, with the group company structure, if you've got intellectual property that's critical to the business, that will generally sit in the holding company so that it's separated from any liabilities and trading risks of the operating or subsidiary entities. As well as if you've got any freehold property that's owned, generally that should be sitting in a separate property company as well to silo out that risk for those properties. The other things or documents that you'll need to make sure are in order for the company are your registers. So that will be your share register, directors register, option holders register, making sure that that's all up to date, as well as your company house filing. So you'll need to be making sure that everything on Companies House has been filed correctly and that actually reflects the current structure of the company and that nothing needs to be updated on there. Any key board or shareholder resolutions that have been passed, you'll want to make sure that there's a formal record of that, because investors will want to see that record. And if you don't actually have that record, then it might be that they might want to see a ratification that resolution actually took place, which is just then signing it now that you previously resolved that was the case. Now, I'll hand over to Sarah, who will go through other aspects that you need to think about when preparing your business for investment.
Thanks. So one of the other big ones is IP. So typically now, a lot of companies are tech companies, even if they're not kind of a classic tech company. A lot of businesses now obviously do rely on apps, for example, on websites. So, most companies now will have IP. So what do I mean when I'm saying IP? It's intellectual property. So that's an intangible property right in something that you've created. So that could be a new product or software or any branding. So there's 3 main types. So one is copyright. This normally gets overlooked in terms of kind of tech companies. But actually, if you do create, say, an app, then the only sort of IP right that exists in that app will be copyright. So that will be copyright, for example, the source code behind the app. Then there's also patents, which are less usual. It really needs to be something that's very unique in order to get patent protection. So typically, you're not necessarily looking at that at an early stage in particular. And then the third one is trademark. So this is more relevant for your branding. So if you've spent money on kind of getting logos done or designs, also sort of a trading name, then you can trademark those things to make sure that no one else is using them. People often think that their company name is enough. It's actually a separate trademark regime. So just because you've got a company name, yes, someone else can't then start another company with that name, but they could perhaps use that name when they're trading. So the best way to protect yourself is a trademark. There are other passing off claims, it's called, that you can rely on, but really if you have that trademark, you know that you have a strong case to stop anyone else from piggybacking off your success. So in terms of DD that investors will look at, if there are important IP rights in the company, they want to know who created it and who owns it. So for example, if you use a developer to make your app, they are the person that created the IP. The default position is that they then own the IP. So what we'd need to be seeing is that in your developer agreement that you have with that person, there is an assignment clause saying that the company owns the IP. And if there's not, that you're making sure you get in place a separate IP assignment deed. Obviously, the company needs to own all the IP, not the developer. So it's really, really important that you're thinking about these things when you are sort of outsourcing any tech creation. In addition, any employees or contractors that are working for you need to make sure you have a robust IP clause in their contracts, again, to make sure the company does own the IP, any that they create now and anything that they perhaps might create in the future. So another aspect is commercial contracts. So I'm just conscious of time, so I'll probably flick through these quite quickly. So we've got client contracts. So these are contracts that you'll have with your customers. Depending on your business, you could have a standard set of T's and C's that you use. There might be some negotiated bespoke contracts as well. But investors will want to make sure that they're well drafted, they're watertight. You can prove that you haven't sort of put the business under any undue risk by entering into something that isn't specific enough about the services you're providing or limit your liability, for example. You've also got supplier contracts. So really it's key suppliers that they'll be focusing on here. If there's anyone that's really important for you to be able to run your business going forward, you want to make sure you do have a written agreement with them. And that includes protections for your business. So things like the supplier giving you warranties about any goods that they're providing to you. Also, clear payment terms are always good. So it's really clear on when you have to pay and what you have to pay. Also, lastly, NDAs. So if you have been sharing any key commercially sensitive information at any stage, then if you don't have a contract in place at that point, it's a good idea to get an NDA signed. If you do have a contract, then you can always put in a confidentiality clause into that contract, and that's sort of what you rely on to make sure that any information shared by either party is protected. So the last one will be employees and contractors, and I'll hand back to Michaela to briefly run through those.
Yeah, so I think the main things that you want to be thinking about, employees and contractors, Sarah briefly touched on suppliers, but with employees, you need to be looking at salary payments, minimum wage, overtime and holiday pay, and pension schemes, just to be making sure, the investor will want to see that everything's above board, making sure it's all in order. The main one here is probably workplace claims. If there are any existing or potential claims, they'll want to understand what the company could possibly be liable for. And you'll also want to make sure that your employment handbooks are all in order as well. Now, for contractors, Sarah did briefly mention it, but one thing here to be mindful of is making sure that they're not actually employees at law and they have been classified as a contractor properly. And the biggest one is your IP assignment. So if you have engaged contractors, making sure that any critical intellectual property for the business is actually assigned to the company from the contractor as well. Now, next, we'll just go through the legal documents that you need to actually raise capital. So I'll hand over to Sarah to start that off.
Thanks. So we're assuming that you're doing an equity capital raise for the purpose of this. So what you would have initially is perhaps a term sheet. So you don't always have a term sheet, depends who the investors are. If it's friends and family, they might not require this. But typically, with larger investors or angel investors, it's a good idea because it will save some negotiation down the line. So the purpose of the term sheet is to set out the key details about the raise. So you'll have things like your round size, your valuation, your share price, and any key rights you're going to be giving investors. So the sort of share class that they're getting, like Michaela spoke about earlier, any board seats they have, for example. It will set out who the investor is, the amount they're investing, and any conditions that need to happen before their investment will complete. So typical ones are things like you do DD before you actually sign the subscription agreement, and there might be certain shareholder approvals that you need to get before you can issue shares to investors. So it's always important to look at your current company documents and work out what approvals you might need. For example, if there are preemption rights for your existing shareholders, so that's where the shareholders have the right to first subscribe for any new shares, they need to have been waived in order for you to give those shares directly to the investor. So that might be a condition that you include. So they're not legally binding other than the confidentiality provision. So as I said, you don't really always need them, but they can be useful to reduce negotiation. So off the back of the term sheet, the main document you would have with your investor is their subscription agreement. So this will also include their investor details, the amount of the investment, the price they're paying for their shares. So this would be where your cap table really comes into use. So you've got your company valuation. To work out the price payable for each share, you would divide that valuation by your fully diluted share capital, and that would pop out the share price that the investor is actually paying to calculate how many shares they're getting. So another thing to think about is if you're going to have multiple investors to fill the round, or if there's just one, and also if there are multiple investors, are they all coming in at the same time, or are they actually investing in tranches? So if they're all coming at the same time, they could perhaps all sign the same subscription agreement. But if there are sort of multiple tranches, then you might need multiple subscription agreements, one for each investor, and sort of bake into each document that there are actually going to be further shares issued. So the investor also waives their preemption rights they might have to allow the company to issue shares up to the full amount of your round. If there are any conditions, as I mentioned for the term sheet, those would also be put into your subscription agreement. So typically DD will be done by then, so that wouldn't be a condition under the subscription agreement, but things like raising a minimum amount of money, getting the founders to sign IP assignment deeds, for example, if that's needed, those would be the sort of things that are conditions to completion under the subscription agreement. And then lastly, also the investors might require the company to give warranties. So again, this tends to be more for angels and VCs that are going to require this, but they're basically asking you to give statements about your business and saying that they are true and correct, and then the investor's investing off the back of that. So it could be warranties around the accounts of the company, the business plan, not necessarily that it's going to come to fruition because you don't know that, but more so that, you know, it's been based on appropriate assumptions and the founders reasonably believe that it is appropriate for the business. So they're normally given by the company. Occasionally the founders do also get asked to stand behind some warranties as well. That tends to happen when the company's a bit further down the line. And then there you're really focusing on sort of liability. So for the company, if there is a breach of warranty, they could be liable to give back the total amount of the investment, or that's the cap. So whatever the loss of the investor is, but capped at the amount of the investment. Founders, obviously, you don't want to be liable up to the total investment amount. You're not actually receiving that. So normally it is linked to 1 or 2 times salary, for example, just to make sure there is sort of some teeth behind those warranties, that you do have some financial repercussion if they're not true. So the last 2 documents are the articles and shareholders agreement, which Michaela will run through with you.
Yeah, definitely. So the first is articles and shareholders agreement. So these will be your key terms which govern the company, and they'll go through things that we've already mentioned. So share classes, share rights, if investors or founders have right to a board seat, if there's preemption rights on the issue or transfer of shares. They could also include what we call drag and tag along rights, which is usually, say, if 75% of shareholders want to sell their shares, they might be able to drag minority shareholders along. And in the same scenario, if they don't drag those minority shareholders, then the minority shareholders might want to tag themselves along to that sale. You may also want to be including, well, investors might require information rights for certain shareholders. And they might also want to impose restrictions on founders. So this is where you might have vesting provisions for your shares. If there's any leaver provisions, if someone's employed or contracted and leave, they may then need to be required to sell back their shares. And there might also be non-compete or restrictive covenants imposed on founders or other shareholders. The other documents you will need to be preparing in your capital raise would be board and shareholder resolutions to approve the issue of shares. You may also need the waiver of preemption rights, depending on the circumstances, as Sarah mentioned. You'll also need to issue new share certificates to new shareholders and update your members register and company's house of all of the changes that have occurred. Now, I am mindful of timing, so that will actually conclude the main part of the webinar, because I know we do have some questions possibly to answer. So on the screen now, you will see a publication which you might find useful. So this is Startup Manual, a legal handbook for UK founders. And I'll just leave that there for a second. There's a QR code so you can scan that. It's a really good publication to have a look at. I would recommend having a read. Perfect. So now I'll move on. That should be enough time to scan that. So there is also another webinar coming up next month on the 21st of May. So this is Understanding Your Business's New Employment Law Obligations. So if you are looking at employing or if you are currently employing individuals, this would be a good one to attend. There is a link there. You can also just Google LegalVision events, webinars, and it should come up there as well. Now, we will be answering some of your questions shortly. So while you submit them, what I'll do is I'll go through our membership. So you should, you'll be able to see that on your slide now. There's a little bit of an overview of the membership. So if you do sign up to become a LegalVision member, what you get access to is unlimited access to all of our specialist lawyers for your business's usual legal needs. So think of it like having your own in-house counsel, but for a fraction of the cost of what you'd normally pay. And as you can see on the screen there, there's lots of different things that we can assist you with. So there's unlimited document drafting and reviewing of business contracts. There's legal advice consultations, domestic trademark registrations. We also do offer what we call an extras fund to any non-business as usual needs. So that would be your complex capital raising, like in the circumstances we've been discussing today. So if you do want to know more about the membership and how we can help you, then there will be the option to request a free consultation at the end with the survey. So would recommend signing up for that if you want to know more. Now we will go through some questions now because we do have some more time to answer those. So I think what I'll do is I'll hand over to Sarah. There's a first one about some angel investors.
Yeah, I thought this was quite a good question actually, because we do come across this a fair bit with people being a bit nervous before undertaking a capital raise. So the question is, I'm friendly with 2 angel investors and both quietly told me if you can avoid investment, do so, as they often take the company off you. In brackets, that's a simplified version of what they said. Love to know from a legal perspective what the ideal investment form looks like. So I thought that was good to raise because, yes, occasionally you do unfortunately hear some stories like this where, founders have unfortunately, lost control of their company. I think what we should focus on here is how could a capital raise lead to something like this? So one area that we often see is founders getting confused around the distinction of board votes and shareholder votes. So often you think, well, I own 80% of my company, so therefore I have control of every decision. But actually the default position is that the directors make decisions. So most decisions are made at board level. Only certain things go up to shareholder vote. And at board level, typically you have 1 vote per director. So it's not at all related to the number of shares that director actually holds. So if you're one founder and you've given a board seat to an investor and maybe a board seat to another investor, immediately there you can be outvoted 2 to 1. So yes, that wouldn't necessarily lead to losing control of your whole company, but it can sort of make you feel like you've lost control because you're suddenly not at the helm anymore, making all the decisions. So that's where it's important to think about board seats and sort of baking those rights into your document so the founder always can be on the board, or perhaps appoint a certain number of directors to the board to make sure that they have control. Another thing that you sometimes see is where a company's on a capital raise but doesn't have any bespoke documents in place. So then what happens is if a shareholder goes above 50%, there is a right in the Companies Act that any majority shareholder can remove a director. So there could be a circumstance in which you get removed as a director from your own company because you've given away more than 50% of the shares. That doesn't mean you're going to be removed if you're an employee. It's two separate things there, but you can be removed as a director. You also see a situation where there have been bespoke documents put in place when you've done a capital raise, but they're either not well drafted or the founder has not been well advised or even advised at all when entering into them. And then what you'll see there is you might have come across sort of leaver provisions or compulsory transfer provisions. So this tends to be where there's danger that they can be used to then take shares off of a founder. So if there was a particularly harsh bad leaver provision, for example, and you fell into territory where you could potentially be considered a bad leaver, the investor could say, right, well, you're now a bad leaver. The consequence of that is that all your shares are transferred from you. You have no say in that. When you get your shares transferred, you lose your board seat. So suddenly there's this cascade of events where, because you've done something, then can categorize you into a certain category in your documents, it triggers all of these events where you may end up losing shares. So this can really be prevented by just having properly negotiated documents. And making sure you do get legal advice before signing any documents with investors. So when we're advising startups, we are acting for the company. So we're trying to protect the founders' interests. So, making sure they do have the right to be on the board, making sure that any leaver provisions are really fair and can only be triggered in certain circumstances where sort of majority of people agree to that decision. It's not just one investor having some sort of say. So yes, you do see this, but it can be mitigated against. So yeah, hopefully that helps answer your question a little bit and sort of alleviates any concern. There's another question. Someone just said to learn more about establishing employee share schemes in the cap table. So Michaela did speak on this earlier, but Michaela, do you want to just kind of recap on how you sort of create an employee share scheme and how you sort of create a pool?
Yeah, definitely. So look, I won't go into too much detail. So if you're wanting more detail around how to establish an employee share scheme, I'd recommend booking in for that free consultation, which comes up at the end. But generally what you'll be looking at is you'll need to create a plan rules, option agreements for each employee to sign up to. You'll also, depending on the type of options that you're offering or shares, you may need to get HMRC to approve the valuation for the strike price before you're offering to employees to make sure that they're receiving certain tax incentives. But there's a whole host of documents you'll need to prepare to make sure that that's actually valid and you can offer the options. The thing, I guess, for capital raising to think about is your cap table, where I was talking about if you've got an allocated option pool, it should be represented on your cap table, even if those options haven't been offered yet, so that investors can see how much their shares may be diluted by once those options are actually offered. But if you do want to, I guess, get more information around employee share schemes and you're looking to establish one, then definitely booking in for that free consultation with us, because it's something we also do on a daily basis as well. Yeah. I think there's another one. We've got not very long, but maybe one time for one more, Sarah.
I can answer the question on, someone said, what's the best way to onboard investors by giving them as little control as possible over the company, excluding debt? I would like to see privileged shares discussed during the webinar. So I think here they may be talking about preference shares rather than privileged shares, but this really ties in with what Michaela was talking about earlier when she was running through the different share classes. So if you're getting an investor, you're not giving them debt, you are giving them shares, but you don't want them to have as much control. The starting point would be try and give them non-voting shares. Doesn't always work. Often angel investors, particularly on VCs, do want voting rights. So if they do want voting rights, kind of the lowest level of share class would be ordinary shares, which would be the shares that you would hold as founders. So they would just rank equally with you. And then one up from this is the preference shares. So I think that's what they mean by privileged shares. So they have a preference normally on liquidation. So you get a preferential return of your money back in the event that there's a sale of the company or the company is wound up, for example. There can also be preferential dividends attaching to shares as well. But sort of that's kind of what you mean when you say preference shares. So purely looking at it from a control perspective, it's the voting rights really that would be relevant there. Looking at it from kind of a overall perspective of giving them additional rights, it would be the preference for the dividend and the liquidation preference that would be applicable. There were two more questions which we're actually unfortunately not going to have time for, but I'll quickly mention them in case it was your question, so we know, we haven't forgotten you. So there was one around how to set the right legal parameters for loans from friends, acquaintances / your network. So more than happy if you want to book in a consultation, we can help run through that with you. I mean, really high level overview is most of it will be a commercial agreement as to what you're happy to agree to with your friends and family. And then in terms of legal parameters, it's more just making sure you've got the right documents in place to set out properly what you have agreed. And then there was one more question that was around, it was quite a general one. It was said fundraising strategy, making international payments, what kinds of online businesses are possible, and finding foreign business partners. So again, a lot of those will be more commercial questions, but definitely, making payments with another currency and kind of what businesses are possible within the remit of the law. They're all things that we can help with. So again, if you want to book in a consultation, we'll be happy to take it forward for you from there. Perfect. So 1 minute over. So that's probably all we have time for today. As I said, there will be a survey at the end that's going to pop up now. So we'd really appreciate it if you could just take 30 seconds to fill this in. It's really useful to get feedback. And that's where then you would put in your details to get your complimentary legal consultation. So I hope you've enjoyed the webinar, taken something useful out of it. Thank you so much for joining us and have a good rest of your day.
Thanks, everyone.